We're joined now by a Duke University professor and a former advisor to the U.S. Fed Board, Ellen Meade. Thank you very much for giving us the time. What did you hear from the Fed today that was fresh, or was there anything?
Well, I think the decision was pretty widely expected, both the no move in the policy rate and also the characterization of the recent data. I think the interesting question is, sort of how are they going to position themselves for future moves and the risk? How do they see the risks at the moment? Are they balanced? And that's where I think we really heard a lot.
In what way? I mean, they did say, of course, that indicate that the higher bond yields are slowing the economy or tending to.
Yeah, but I think, in his statement, for instance, Powell put down kind of a marker that a few months of good data are only the beginning of what it takes to build confidence that inflation is moving down sustainably and that it still had a long way to go. So that's putting down a marker that they're still leaning into the inflation side of the risks. Although later on, when he was asked about whether they still had a tightening bias, he said yes, but then he said he thought the risks were more firmly balanced. He put down some markers around financial conditions. You're right, absolutely, that they mentioned them, but he said there were two key things about the recent tightening in financial conditions. The first is that it's persistent and that it remains. It doesn't go away, say, after the press conference or later this week. And the second, that it's not arising from a market view that inflation expectations have risen or that the Fed needs to take more policy action, really that it's coming from term premiums. He didn't say that directly, but he's been communicating about that, and I think that's what he means.
Sorry, you went a bit technical there. What are term premiums? Please explain.
So term premiums would be the additional compensation that investors holding longer-term bonds would need beyond expected changes in interest rates. It would be risk premiums that they need for holding longer-term debt. And there's been a lot of discussion around this lately by a couple of different Fed policymakers, by Powell and his statement a week or so ago at the Economic Club of New York a couple of weeks ago. The idea being that maybe it's because of the size of the deficit now and the amount of debt that the Treasury is auctioning. Possibly it's in some part because of the Fed's QT. They've run their balance sheet down by $1 trillion since June 2022. So it would be the extra compensation that investors are requiring to hold the debt.
You have written in the past on possible hazards with central bank transparency, and I think your focus there was under Alan Greenspan. People on the rate-setting committee were nervous about being too forthright because they thought that their discussions would become public later. Is this a problem?
So I think that was a long time ago. As you said, that was in the early 1990s, around the time that the Fed first started publishing the transcripts of the policy meetings. As you know, they're published after 5 years, so there's a 5-year delay. Many people who have used to attend the meetings say that the character of those meetings changed after that. And people read, they certainly do these days, read prepared statements into the record, and that becomes part of the transcript. I think they've gotten around that, though. They have a very genuine and full of exchange conversation over the course of 2 days. The transparency world is here very firmly now, and I don't think it's going away. So the extent to which the release of those transcripts has basically stifled their debate, I think, maybe much the reverse, that maybe there's so much going on in public that it's not helpful to them.